Hello, YouTube friends.
Of where the bubble might be in this market. It is not in.
Today, we are gonna get some real investing pearls from Cathie Wood. I spent 5 hours watching a 48-minute video. Come on, drop a like. If you got the time, then go and watch the full video. But if you wanted to save some time, well then you came to the right place. Cathie Wood is gonna break down two companies that are really just slept on.
You did, Mary. You electrified the entire automobile industry. I'm serious. You led, and it matters.
Really? Joey? Really? GM supposedly led, but in Q4 they only delivered 26 EVs. Tesla, on the other hand, only delivered a small amount, like 308,600 in the same quarter. But GM led. Really, Joey? Really?
And it matters.
Cathie breaks down how analysts and investors alike are not doing enough homework and are missing these deep value territory stocks. Cathie gives her insights into the recent crypto and equity market correction. Cathie then ties it all back together and breaks down why she sees a potential auto bubble coming. Come on, Cathie, bless us with your investing pearls.
Teladoc has about $2 billion in sales. Its revenues have gone up fourfold since the beginning of the coronavirus. And we don't think that its revenues are going to go down. A focus on year-over-year momentum and the comparison that we're going to see, and this is the last of the really tough comparisons. Zoom's revenue 1 year ago, fourth quarter, was up 370%. And in this fourth quarter, the quarter they will report soon, we believe, and their guidance is that revenue will be up 19 to 20%. Think about that. On top of 370%, up 19 to 20%. And that's probably the low point of its growth rate. And we're going to accelerate, we believe, or Zoom's revenue growth is going to accelerate from there. I gave you Zoom. Its revenue, is up 6.5-fold since the beginning of the coronavirus. Teladoc, another stock, telehealth, its revenue is up fourfold. And the Teladoc's revenue is $2 billion on average per year, or this last year. Zoom's about $1 billion. So these are real companies. Their gross margins for Teladoc, they're in the 60s, high 60s. For Zoom, in the low 70s. I may be mixing some of these numbers up, but you've got the point. Very high gross margins, solid revenues, growth continuing from very tough comparisons. And we've got two companies here that are being dismissed as stay-at-home stocks that are going to fall back to earth. And we believe they are not stay-at-home stocks. They are stay-connected stocks, stay globally connected, stay competitive, stay globally competitive. Teladoc being the backbone of the healthcare system from an information point of view here in the United States. And Zoom becoming one of the most important companies, we believe, in the enterprise communication space. Communications is a $1.5 trillion market, enterprise communications globally. And we believe that Microsoft and Zoom together are going to benefit from the first, quote unquote, rip and replace cycle since the early days of the internet in the early 90s when Cisco came of age. We believe that the dismissal of these stocks is quite misplaced and suggests that analysts or investors are not doing their homework and sizing these markets appropriately.
Cathie is dropping some real knowledge here. I hope you are getting it. I hope you can hear in my voice how excited I am to hear this info. Just to sum up quickly, her point is these stocks are representing a deep discount and are representing a great buy. Let's get back to Cathie for some more knowledge.
In the crypto markets, we're seeing a correction. They are starting to succumb to what we're seeing in the equity market, which is this strike against technology, growth, innovation. We think that's going to be short-lived.
Cathie said she sees this correction as being short-lived, but did add earlier that she didn't know how long the market will stay irrational for, stating it could be 3 months or more. Personally, I believe that the Fed ceasing quantitative easing, which is likely to complete around March, and then the multiple interest rate hikes to come, the crypto and equity markets could see more weakness.
November, 12.86. December, we just got this number, 12.44. Meanwhile, you've got electric vehicle sales up nearly 100% at an annual rate. What's going on here? Well, it could be a combination of consumer sentiment not being happy about what's going on, and a consumer preference shift towards electric vehicles. That is why at the CES show, the Consumer Electronics Show, you heard these auto OEMs talking more about electric vehicles. Of course, it was the electronics show. And we saw that Ford's F-150 Lightning, that they were going to have to double production given all of the demand. Well, what they don't tell you during those appearances at CES and so forth is that electric vehicles make up maybe 2 to 3% of their sales, and that 97% of their revenue bases are gas-powered vehicles. And it's probably 90% plus of their production now. If there is the combination of the consumer turning off, not wanting to spend as much money, certainly not on big ticket items, and a preference shift, if they're going to spend, they're going to spend on electric, then these OEMs have an issue. They have a problem. And we think we're going to hear more about it in the quarterly reports. And we hope analysts start asking about it. Now, I look at the performance of stocks like GM and Ford. They soared on those electric vehicle announcements. Think about that. That's ridiculous. It's only 2% of their sales. And what if the other 98% or so forth are on their way out as the consumer preference shifts toward electric? They have problems. They have problems because their gross margins, depending on the company, are somewhere between 10 and 20%. Those are very low gross margins. And if you look at the Bloomberg estimates for this year, 2022, after a very weak 2021, you see growth estimates in the 10, 15, 20% range. The US-based ones are at the higher end of that. Well, that may not happen. And again, they don't have a lot of room for error. And we have seen them pivoting and announcing that they're pivoting ever more quickly towards electric. But the problem is almost 100% of their base is going to go obsolete over time. So very, very interesting there. And I'd like to end right now by talking through just one more thing, going back to autos and giving you a sense of where the bubble might be in this market. It is not in innovation stocks. They've been cut in half, many of them, some by 75%.
Story time with Cathie. Go and grab your popcorn or your coffee and listen up.
But listen to this. I gave you the story about Ford reporting that it would have to double its electric vehicle production of the F-150 Lightning, and the stock just taking off, not paying any attention to the auto statistics I just mentioned. Well, when I think of what could happen in that space, and I see these stocks ramping on sales that mean nothing to these companies, in terms of their earnings, shall we say, right now. In fact, they need to invest a lot more in electric to make it happen and to move the needle in these companies. But what if we're right and there is not a 20% increase in sales? Maybe sales are flattish year to year. That would put them at roughly 15 million units. And they probably have to start cutting prices if we're right on the used car market and the pricing there, which means they're probably going to be facing some credit issues since they're hugely leveraged to the credit that people take out on their autos. And as prices go down, residual values go down. And, auto credit was the best performing credit in 0809. And so there's a lot of complacency in that market. In 0809, the homeowner had to decide, okay, I can't pay everything. I'm out of work. What do I pay to just keep things going? Well, they were going to pay their auto loan down and default on their mortgage because it would take a while for them to get kicked out of their house, but they needed to get to their jobs. Today, that would change because of ride hailing. So we think that complacency is misplaced and that the auto credits out there could become a mess. So if I'm right on any of this, there will be disappointments in terms of the auto sector. And I wouldn't be surprised if at least one of the companies loses money next year, which would be most unexpected. And if it loses money, what is that valuation? Where are the crazy valuations now? Are they in our stocks? Now that Zoom is down to 33 or 35 times this year's earnings? Or is it in an auto stock where there might be losses? And what's that PE ratio? That's infinity. That's where the bubble is. And I think you're going to see a lot more cases in point as this year moves along and the innovation that we see evolving so rapidly. DNA sequencing, transforming healthcare, robotics solving the labor shortage problem we're having, energy storage, the consumer preference towards electric, artificial intelligence, which is the glue that is helping all of these technologies converge. And the last one, blockchain technology. We think that we're in a period of innovation that was the dream in the late 90s. But those companies were vaporware. They were based on nothing but eyeballs. We have real revenues. We have incredible growth rates. And if we're right and the economy has an inventory problem, then our growth rates are going to look far superior to anything you'd find in the value space. And we are really looking forward to that.
Every month, Cathy gives out some deep investing knowledge. I will be breaking it down right here and giving you just the highlights and some interpretation, as Cathy definitely gets very technical. So like, subscribe, and hit that notification bell to get notified as soon as I drop the next time-saving video. I just want to expand on what Cathy was saying. I am definitely looking forward to taking advantage of these two deep value territory stocks. Currently, I do not see an entry. When a stock has seen massive weakness, and in these cases over a long period of time, I like to see consolidation and then a reason for entry. Join my Patron below to get instant updates of when I am taking entry on these. Note, Cathy pointing out that some of the OEM autos have a gross margin of only 10 and 20%, whereas Teladoc and Zoom are between 60 and 70% gross margin. As Cathy said, some of these OEMs have silly valuations. I completely agree that negative results will compound their issues. With inventory numbers rising and the Fed's plans as mentioned above, as well as the fact that legacy autos mainstreams are heading towards becoming obsolete, I personally am glad I do not own these companies. And if you do, maybe look harder at your investment. Kathy pointed out earlier in her talk that if growth numbers don't come for these companies as they're expecting, it is a big issue. Compounding the issue, these ICE vehicles are going to continue to drop. Financing will not be as generous as it was in the past, leading to even lower prices for ICE vehicles and even smaller margins. OEMs will have to continue to pivot to EVs, but this is not going to be so simple when they attempt to ramp up their production and hit production issues. Margins will continue to drop, and investors, if they are smart, are not going to be funding the outlay for these companies into EVs. Think about it. If you're an investor in one of these companies and then they end up losing money, and then their now average PE, so their price to earnings ratio, which currently ranges from around 5 to the mid 30s, no idea how one of these companies has a PE of close to mid 30s when this is going on. The slim margins and declining sales makes no sense, and the issue they will run into when they're trying to compete with Tesla for the EV market share. I'm sure the media will say, hey, look, XYZ company is taking Tesla's market share. This will happen and not mean what it seems. Q2 2020, Tesla was said to have a 79% EV market share, and in Q2 2021, this is claimed to have dropped to 66.8. To give you another way to look at this, Apple is said to only have 14.1% of the phone market, but they are number one.
And it matters.
Number one matters. Tesla will continue to lose market share, and this is fine. In fact, it is expected. In the future, Tesla will only have 25% of the EV market. They will still be number one, and today's discount prices will look cheap. How many people will have missed an opportunity of a lifetime? Not financial advice, but don't be one of those people. If you would like to have a deeper look at Tesla Q4 production numbers, then click on the video in the top right hand corner.